On February 2nd, 2026, spot gold was trading around $4,670 an ounce, after touching record highs near $5,595 just days earlier. Spot silver was around $81, after ripping up toward $120 and then collapsing in a rush. And here's the weird part. When gold and silver crash like that, the basic assumption is simple. That money should rotate into stocks, but stocks didn't react like they got a giant inflow. The S&P 500 is only up about 2% year to date. The US dollar index firmed from about 96.99 on Friday to roughly 97.5 today. Money market fund assets are sitting near $7.71 trillion. Bitcoin's trading around 78,000 after getting hit in the same risk wave. And the VIX spiked near 20, then faded back toward the mid-teens. So let's ask the question everyone assumes they already know the answer to. If gold and silver just got crushed, why didn't stocks rip higher? Because if $1 trillion left metals, it should have showed up somewhere loud. Small caps, tech, anything. But it didn't. Which means either the money moved somewhere you're not looking, or the money didn't move at all. It vanished. And that's what we're doing today. I'm going to track this like a detective, not like a commentator. No vibes, no slogans, just plumbing. And here's the promise. By the end, this won't feel mysterious. It'll look like 3 pipes. One pipe is obvious, one pipe is hidden, and one pipe doesn't look like a pipe at all. Once you see them, you'll also understand why stocks barely moved, even while metals got wrecked. Now, before we follow the money, we need to fix one idea that messes up almost everyone. People talk like markets are a mall. Money leaves one store and walks into another. But a crash doesn't behave like a mall. A crash behaves like a fire alarm in a crowded building. When the alarm goes off, nobody calmly compares deals. They run for the nearest exit, even if it's the same exit everyone else is trying to use. That's the first key. In a stress move, cash doesn't chase returns. Cash chases survival. Now, the second key is the one that makes this feel like a mystery. When gold drops, the money doesn't automatically become cash. A crash is not a suitcase changing hands, it's a valuation collapsing on a screen. If you owned $1 million of something yesterday, and it's worth $900,000 today, the missing $100,000 didn't rotate. It got erased. That's why, where did the money go, is such a powerful question. Because the honest answer is sometimes it didn't go anywhere. It disappeared as paper value. Now, the third key is the hidden pipe. And this is where the detective story turns into a mechanics lesson. Right into the sell-off, the rules of leverage tightened. Margins were raised on the big futures venues. Gold margin moved from about 6% to about 8%. Silver margin moved from about 11% to about 15%. That sounds small until you translate it. If you're leveraged, a margin increase is a bill due right now, not next month, not after you wait for a bounce. Now. And when that bill shows up, traders don't say, "Great, let's buy the S&P." They say, "I need cash," immediately. So the next move isn't rotation. The next move is forced selling and forced funding. This is the line that makes the whole story click. Rotation moves money. Deleveraging deletes buying power. Hold on to that. We're going to prove it, pipe by pipe. Because once you see which pipe is active, you can stop guessing. And you can stop falling for the lazy headline that says, "Gold crashed, so risk is back." Not always. Sometimes gold crashes because risk is breaking. So here's how we run the investigation. We check the obvious destinations first. Then we check the quiet destinations. Then we check the hidden destination that most people never mention on purpose. And in the middle, we're going to hit one cliffhanger. Because there's one market that tells the truth faster than all the others. It's not stocks, it's not gold, it's credit. But we're not there yet. First pipe, the US dollar. This is the simplest place missing money shows up. Not because everyone loves the dollar, because the dollar is the settlement layer, is the RTIA. In modern markets, leverage is basically rented oxygen. When the oxygen gets cut, everyone is forced to pay in the same currency. Cash. And most global cash demand resolves into dollars. So when metals dump and margins tighten, the system demands dollar liquidity. That demand can push the dollar index up even if nobody is cheering. That's exactly the footprint you saw. DXY firmed from the high 96s into the 97s. Digestion beat. A 1% move in DXY sounds boring, but in plumbing terms it's water pressure changing. In a whole building, it changes the stress on every valve at once. Now, does that explain everything? No. The dollar is a pipe, but it's not the whole building. Second pipe, Treasuries. In a classic fear trade, you'd expect a stampede into government bonds. Yield should fall sharply as prices rise. But that's not what the tape looked like. The 10-year yield was still around the low 4% range. It didn't collapse like a recession panic. The 2-year sat around the mid 3% range. That's a tell. It says the market wasn't screaming, growth is dead tomorrow. It was screaming, cash is needed today. Analogy number 2. This wasn't people moving to a safer neighbourhood. This was people paying a sudden repair bill. Third pipe, money market funds. This is the quiet one. And it matters because the quiet pipe is where stress hides. Money market fund assets are around $7.71 trillion. That's not a trade, that's a parking lot. And this time the parking lot pays. With policy rates still in the mid-threes, cash yields are real again, so sitting still doesn't feel like punishment. Oh, it feels like relief. Digestion beat. In a world where cash pays, investors don't need to reach as hard. They can pause and get paid. That changes the character of every sell-off. Now, if you stop the investigation here, you'd say, okay, the money went to cash. And some of it did. But this still doesn't explain the core contradiction, because if the move was just a calm rotation into cash, you'd expect cleaner behaviour elsewhere. You wouldn't expect silver to act like it fell down an elevator shaft. You wouldn't expect crypto liquidations. You wouldn't expect volatility to spike, then snap back. So we move to the hidden pipe, and this is where the story becomes uncomfortable. The hidden pipe is collateral, margin, forced settlement. In a leveraged market, the first destination for cash isn't a new investment, and it's the clearing system, because the clearing system doesn't care about narratives, it cares about whether you can pay. When margins rise, the system is effectively saying, prove you can afford your position. If you can't, the position gets cut. And here's the trap. When positions get cut, buying power doesn't relocate. Buying power shrinks. Analogy number 3. Think of leverage like driving on a highway. Margin is the speed limit sign. When the speed limit drops, everyone who is speeding slams the brakes. That doesn't create a new destination. It creates a pile-up risk. And if that pile-up risk shows up, people sell whatever they can sell, not what they want to sell. That's why you can see metals crashing, while stocks don't celebrate. Because the selling pressure isn't about preference, it's about funding. Now, let's make that real with the silver move. Silver is thinner than gold, it's more volatile, it attracts more leverage. So when it squeezes, it overshoots. And when it unwinds, it overshoots the other direction too. Silver isn't just a metal story, it's a leverage story. That's why it can look like a market cap disappearance event. Not because $1 trillion physically moved, because a leveraged pyramid just got kicked. Digestion beat. People imagine money as a suitcase, but in leveraged markets, a lot of money is a claim on collateral. When that claim gets called, the suitcase burns. Now we bring equities back in. If metals were dumping and cash was being demanded, what should stocks do? They can do two things at the same time. That's the confusing part. Some investors can buy dips, while others are forced to sell to raise cash. So the index can look calm even when the internals are stressed. That's why the S&P being only modestly higher year to date doesn't disprove your premise. It supports it. If a giant rotation happened, you'd see it in a way that's hard to miss. Instead, what you saw was mixed behaviour. A little relief here, a little stress there, not a victory parade. Now here's the mid-script cliffhanger, because this is where the detective story earns its title. If the money didn't rotate cleanly into stocks, and it didn't clearly stampede into bonds, and crypto didn't absorb it, then where does stress show up next if it spreads? Credit. Credit is the lie detector. Stocks can drift, commodities can whipsaw, currencies can grind. But credit spreads reveal whether the system is tightening. So the next question isn't, will gold bounce tomorrow? The next question is this contained, or is funding getting tighter across the board? That's the difference between a scary chart and a structural event. Now, we're not going to turn this into doom. This is about mechanics. So what do you watch to know which world you're in first? You watch the dollar. If the dollar keeps firming while risk assets wobble, that's the system still demanding liquidity. It's the building still pushing people toward the exit. Second, watch volatility. VIX spiking and then fading as the market saying, "Collateral? We're not sure yet." It's hedging demand staying alive. Third, watch cash parking. Money market assets staying elevated tells you one simple thing. A lot of capital is choosing pause over risk. And fourth, watch credit spreads. Because if spreads stay contained, then this was a violent unwind that ends. If spreads widen, then the unwind is infecting funding. Now let's tie this back to your title, because your title is the hook. Gold lost $1 trillion, but stocks barely moved. If someone tries to dunk on that, you answer with one sentence. We're not describing a suitcase moving. We're describing mark-to-market value collapsing and leveraged exposure being forced to unwind. That makes your framing solid, and it makes the reveal stronger. Because the reveal isn't, the money went to some secret asset. The reveal is, the money went into the pipes. Some into the dollar, some into cash vehicles, some into collateral. And a chunk didn't go anywhere. It got erased as valuation. Now the first echo, because this is the core theme. Rotation moves money. Deleveraging deletes buying power. That's why the S&P didn't rip, because this wasn't a clean handoff. It was a repair. Analogy number 4. It's like a city after a storm. The first spending isn't on new houses. It's on clearing debris and restoring power. That's what collateral calls do. They force the system to restore power before anyone builds anything new. And now, after 400 words, we can say the historical parallel without breaking the pacing. This is why the first phase of 2008 looked like everything was falling together, and why March 2020 looked like gold dropping right when fear was highest. In a true funding squeeze, correlation goes to 1. Things that should hedge can drop 2, because cash demand overrides logic. That doesn't mean the world ends. It means the plumbing is in charge. So what does this mean for the viewer watching the tape? It means stop using the wrong mental model. If you assume a crash always creates a clean rotation, you'll keep getting confused, and you'll keep getting whipsawed by narratives. Instead, use the 3-pipe model. Pipe 1, dollars and cash. Pipe 2, safety assets like treasuries, but only when it's a true fear bid. See Pipe 3, collateral, margin, settlement, the hidden pipe. When Pipe 3 is active, price moves don't behave politely. They behave like forced exits. And when forced exits happen, the missing money is often just leverage collapsing. Now we land the answer cleanly. Where did the money go? Some of it went into the dollar because the system settles in dollars. Some of it went into cash parking lots because cash yields still pay. Some of it went into the clearing system as collateral because margins tightened. And a meaningful chunk didn't go anywhere. It vanished as paper value when prices reset. That's why stocks didn't rip higher. Because this wasn't a celebration where gold hands the baton to equities. This was a contraction where buying power got pulled back. Now the second echo, and because we want the viewer to remember the mechanism. Rotation moves money. Deleveraging deletes buying power. So the final open loop is simple. If this was a one-off deleveraging flush, you'll see the pipes relax. The dollar stops firming. Volatility calms down. Credit spreads stay stable. Cash parking slows. But if the pipes stay tight, then the market is telling you something deeper. Not about gold, not about silver, about funding. That's why this "where did the money go" story matters. Because it's not actually a metal story. It's a system story. And once you learn to read the pipes, you stop getting surprised by the surface. You stop asking, why didn't stocks rally? And you start asking the better question. What did the system demand first? Today, the answer looked like cash, collateral, and repair. Not rotation,